Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. We've made it to Thursday, April 24th, 11 a.m. on the East Coast. There's an old saying, when the cat's away, the mice, they shall play. Well, the cat is away. He's away down in the FLA. I think he's going to see the Pearl Jam tonight with the person you see on the screen. That, of course, the great Danny Moses of Moses Ventures, joining me for the next half hour or more, depending on how long we want to go. By the way, send your questions now in the chat. Blow up Amanda's email or whatever the hell they call it. Danny, how are you?
I'm good, Guy. How you doing? It's nice to only travel 25 minutes for a Pearl Jam show. So I got the good end of this one.
I think it's, listen, I'm not as you know, I like the Pearl Jam. I'm not like you and Dan, who are just sort of like Pearl Jam junkies or groupies, I would say. Dan will probably, if this is probably his 50th Pearl Jam show, you're probably approaching that. But you thought this market reminded you of a lyric from one of their songs, which I am not familiar with, but perhaps you could just sort of share it with our audience here.
Well, one of their best songs ever is Nothing Man. And it feels like a nothing man or nothing woman market. And when you think about the lyrics to the song, about, if you want to make them about tariffs, once divided, nothing left to subtract. Some words that are spoken can't be taken back. Well, we came up with this tariff concoction. We divided it by 2, right? There's nothing left to subtract from that because you're trading the end of the world if these were to stay in place. And you say stuff all the time out and you want them to take them back. But unfortunately, some of the words that are out there, I don't think that the market premium will ever come back, at least near term, to what it was on the S&P 500. So I think that's what we're dealing with.
Look at you. Not Nowhere Man from the Beatles. This would be, of course, Nothing Man. We'll put that in the show notes. I don't even know what that means. Dan says it all the time, so I figured I would say it. But, that leads us to the first slide of the day in Canvas, and that's people just throwing in the towels, Danny, to your point. And this comes in the form of Deutsche Bank, their Blinky Chadra, not Blinky, it's Binky, I know.
Binky.
One of the biggest bulls entering the year has basically said, you know what? We got to sort of throw it in. Now, with all that said, the price target that was reduced to went from 7,000, which seems light years away currently, down to 6,150. So, that's still, I think, somewhat aggressive because if I'm not mistaken, 6,150-ish is the all-time high that we made in the S&P 500. I want to say when, Danny? It was probably in, February or so, February 18th. So they're basically saying, I guess, that we have a chance to retrace back to the levels that we started the year from. So that move down from 7,000 is noteworthy. But what I'll say to you is this sort of, it's not the first, but is this sort of a continuation of a theme here? Because when you start to do the math, and something you said a few minutes ago in terms of you don't see those same premiums, it comes down to a couple things, and maybe Amanda wants to throw an S&P chart up. Comes down to earnings growth, revenue, and revenue growth. And almost more importantly, what the multiple the market is willing to attach to that earnings. And, I would submit in this environment, it's certainly not 22. Now, maybe it's not 14 or 13, which we have seen before, but it's probably somewhere between, I would imagine, 14 and 20. And a historic multiple is about 17. So here's the chart. You saw we broke down. We can draw another chart in a second, and I'll show you some trend lines. But we clearly broke both the 50 and 200-day. The 50-day moving average, for the first time in a long time, has now crossed the 200-day. A lot of people deem that to be something called a death cross. Now, it doesn't mean we can't trade back up to the 200-day. But to your earlier point, I think we're challenged here.
It really depends on where you are in the cycle. Right, the multiple that you're willing to put on. Obviously, when you think things have bottomed from a cyclical perspective, you're going to pay a very high multiple because you know that you're going to grow into it because you're going to bounce. And the flip side is true when you know that you're at the top, vice versa. Binky has always been a perennial bull. We used to talk to him, from time to time. And let's keep in mind, we entered in January with 19 of the top 19 strategists all having targets in the mid 6,000s, right? Mm-hmm. He was probably near the high at 7,000. So if you're bullish, these are the things that you want to see, but you want to see Binky coming down to 5,000 or 4,800. So if you want to look at the S&P as a whole here and where we are in the cycle, the irony in all of this is that before the tariffs announcement and the poster board moment, things were slowing already. And as a matter of fact, the irony of all of this is I think Powell was intent and was going to actually cut rates in May. But the unknown was what the tariffs would or are going to do for inflation and stoke it. So I think we were on pace to do that anyway. So I think we're in a slowdown. But more than that, Guy, even if we get through this tariff noise, which we will and we have to, the premium that the S&P was garnering, to your point, 23 times forward 2025 earnings, which were around 270 when we flip the calendar. Now you're probably going to end up in the 240 to 250 range. The question becomes, is that the bottom, or are we going to enter a long cycle of uncertainty? So my feeling is this: you got to take off some type of premium for where the S&P was trading. That's based on the dollars leaving the market. People were parking in U.S. equities just to express dollar positioning. And so I don't know, call that 20%. So let's go to 19 and then call a slowdown. I think 17 times is probably a number if you really want to try to trade the market on valuation. But Guy, more than that, I think it's a stock picker's market. It has been for the last 2 to 3 years. And you've seen baskets of stocks, which I know we're going to get into some of them, that screens are being run. Okay, who's not impacted by tariffs? Who has a clean balance sheet? Who's going to survive this? And yes, while the stock may be a little bit expensive, I'll pay a premium for it knowing that I'm safe.
Well, you're willing to pay that premium knowing there's some degree of certainty. And obviously, and it's funny, and I get a little agitated by this, and I'm not suggesting any of us do it, but you hear it all the time, that mantra, the market hates uncertainty. And it makes me sort of wince, because when is there really ever certainty? I think the real thing is the market hates elevated periods of uncertainty, because uncertainty is always there. The level of uncertainty, though, is somewhat, well, I don't want to say unprecedented, but probably things we haven't seen in quite some time, to your point. And, you're right to mention that people are going to start to ratchet down their numbers. And that's something you absolutely want to see, because that would suggest that people throwing in the towel. But it does come down to, what type of environment that we're going into. And I know you're a fan of the Hunt for Red October. I know you're a Sean Connery guy.
Absolutely.
You remember there's a scene when one of the other Russian sub-commanders, the one that was trained by, what was his name? Ramius, I believe. Is that correct?
Ramius.
Yeah. And, he's hunting him, and he's you could see he's like salivating. He's foaming at the mouth, basically with the ability to finally catch his mentor and the person that maybe he's looked up to all his life. And what he forgets to do, obviously, is he sort of leads his submarine towards, he doesn't take off the safeties in his missiles, if you recall, right? And the torpedoes. And, Sean Connery closes.
One ping only.
Yeah. But my point is, the arrogance of that other captain got him killed. And that's sort of what you're saying. If they had just allowed this, if they had just sort of kept quiet on this whole tariff front, the administration would have gotten what they wanted to get in the form of lower rates, is my sense, to your point. But once they introduced that unknown of tariffs and stuff, they basically shot themselves in the foot. But we'll see how that all plays out. Now, I want Amanda, if she can, to give me an S&P chart going back to sort of 2020. And we've drawn this trend line a number of times. By the way, this is a trend line that Carter Braxton Worth has drawn, and something that we've talked about. But, if you go longer term, go to that low back in like March, April 2020 and draw that uptrend line, and you will see that we basically stopped dead on it, Danny Moses. I mean, close enough for government work, as they say. So that made sense, and we talked about it on this show that we thought we'd get down there. The bounce makes sense. My question to you is, if you look at this, do you say that we hold a long-term trend line, and maybe this is just going to be some noise until things get basically fixed and then we're off to the races again? Or to your earlier point, are we in a slowdown right now that everybody's been anticipating for the last couple of years? And regardless of technicals, fundamentals are actually going to start to take over.
It feels range bound, but within that range bound market, there's going to be a lot of opportunities, I think, to buy and to sell. So I think it's very key on the big downdrafts, scoop up quality. On the big up moves, sell the junk, sell the high beta stuff that is just kind of rebounding with the markets. And so I'm not going to try to predict the S&P per se, but if you made me pick, I would say lower. I do think we're in a tight range here. So let's see, as we're halfway through kind of reporting season, or we're getting close to halfway through reporting season. You're seeing in real time a look at the market, which I think is key. I would tell people, pay attention, pick a sector, pick a company, listen to the conference call or read a transcript. I know that sounds really exciting. Listen to that. Don't listen to market strategists, and don't listen to us. Listen to what corporate CEOs are telling you. listen, it's not a shock that the CEOs of Walmart, Target, and Lowe's and Home Depot went to visit the White House. And I guess the idea of empty shelves at Walmart got through. And so we're going to have that regardless, Guy. The question is, so this is not, so two ways to look at it. This is going to get remedied. So you want to own the companies, obviously, that will do well in that situation. But again, the premium in the market, the uncertainty, you just don't know. I'm not convinced that 13 days from now, Trump doesn't go back after Powell again if he doesn't get what he wants that day. I will say the flip side of this, let's keep in mind, we were already previewing QE5, and I think that's going to happen. So Powell said last meeting that they're going to let mortgage-backed securities run off and use the proceeds and reinvest into Treasury. So let's be clear. That tool is coming back out of the kit here. So maybe on the long end of the curve trying to predict that. But, Guy, I would make people realize that the 10-year yield is not the be-all, end-all. You need to look at the real economy through the lens of credit spreads in that world. So while 10-year yields can come in, if the real economy is doing poor, credit spreads will widen, and it's a false flag as far as feeling like it's green light. So a lot there. Sorry, Guy, but there's a lot to look at within that.
In the course of that, I'll give you white flag from Dido. I'll give you remedy that you said. That, of course, is from the Black Crowes. And listen to your heart, of course, from the great band Roxette. Danny mentioned all those three in this last bit of a soliloquy. So let's look at this next slide. Now, this is right up your alley because this speaks to people sort of fleeing the dollar. And that's Sir Thomas Wyatt for you fans of poetry out there. They flee from me. That's a poem that I memorized when I was in high school. I'll spare you, but people are fleeing from the US dollar. And this FT article speaks to exactly that. And again, we're seeing moves in currencies. By the way, dollar yen, which I know you watch very closely, traded down to 140 and change the other day. By the way, it subsequently bounced, which is probably a good thing. But the weakness in the dollar, Danny, has been noteworthy and somewhat unprecedented.
Yeah, Peter Bookbar nailed this at the beginning of the year. He said, watch the Mag 7, because that's how people are expressing their dollar deposits, is just sitting in U.S. equities in the Mag 7. And so kind of they're one and the same, right? And I know this article talks about the fact that the dollar could have a lot more to fall if people were to keep selling U.S. equities. So they're kind of tied in. Gold is obviously the barometer for this, and we've seen that. Gold strengthens on dollar weakness, but when dollar weakness is caused by man-made issues, meaning self-inflicted, gold even goes up more because not just geopolitics, but just the uncertainty kind of around it. The Bank of Japan, keep in mind, has a meeting next week. I think they're going to leave rates unchanged, so we'll see what happens, because if you look at their yields, again, they're much lower on an absolute basis than they've been. They dropped big. Their 10-year yield dropped big. We could bring that up if you want. It's probably maybe a tough one to find. They bounced back. Everything's kind of in no man's land in the sense of things are going to pick a direction here. So your point about the yen is a good one. The yen strength, it got down to 140. We breached that again. These are the things that you have to watch from a plumbing perspective that you really want to ignore. But if you want to find out, hey, why is the market down so much? Why did that macro fund get shut down? You need to understand that these things can trigger those type of events. And that's why it's really important to watch this. So we'll see how it plays out. But I don't see the dollar strengthening anytime soon, given the current situation that we're in. So I think that's going to continue to be an issue.
So leave that dollar yen chart up for a second, Amanda, because this is actually sort of interesting. Obviously, in this chart, just in this chart alone, you've had the 50-day crossing the 200-day to the downside last summer. I think we all remember what happened there. You had subsequently crossing it to the upside basically in the winter early this year, only to have it cross back down earlier this spring. I mean, this is dollar yen. This is not some developing country currency. I mean, this is the fourth or fifth largest economy in the world. Currencies trading like this against the dollar. Now, if you were so inclined, and this is not a futures day, but if it was, I mean, here's an opportunity to buy dollars, sell yen against the low that we saw back in the fall. I mean, this is a nice short-term double bottom, and you can see dollar rally up to about 148, if not 150, and still be what I declare in this sort of downtrend still. So I think this is a really fun chart if you're looking, for you folks out there that are looking to sort of trade around the dollar. We have a question for you, Danny, since you're here. This is from Eric Lancelotti, who is with us every day. Can Danny give us an update on Genie? That comes out Geni, not Barbara Eden Genie, by the way, for you I Dream Of fans, but Genie, the sports gambling site.
Yeah, they continue to do well. Love the name, not affected by tariffs. Could be slightly affected by a down economy if people just gamble less. Stocks held up great, touched 11 recently. Oh, look at that. You have the chart up there.
Goes to 11.
Keep in mind, this was a SPAC. So technically speaking, 10 is just the level that you're going to be watching. Sport Radar, SRAD, and Genie have both had big runs. Sport Radar actually has had a bigger run here, but I think these things are off to the races. And it's not just about the sports gambling. And keep in mind, Genius makes more money when people are making in-game live wagers. Not good for them, great for the house. And when people are betting parlays and so forth. So the trend is in their favor. They're into media now. It's a big tech company. So big fan of Genie here, and it's held up well. And so on a relative basis, both those names look great.
I just want you to see how much people love you. Amanda can start to pull these up one.
That's only because you're filtering the hate out.
No, I'm not filtering anything. This is from Air Max Reborn 89. Danny Moses is an animal. I don't know. Oh, is that a goat? Is that what that means?
Pig, goat. I don't know.
The whole time.
Okay.
M Tanaka 5 pitched for the Yankees. Great to see Danny Moses today. Adam B. Call them all Daniel. Don't know what that means. Matthew Stevick, not Michael Stivick, who I know you're familiar with. Danny Moses. And then Mr. Tanaka again. Dan N said on Wednesday, that's Dan Nathan, not been called Danny since junior high days. Danny M has kept it. Danny, can you call Dan out next time you speak to him? So I guess embedded in that, why are you still Danny and why is he Dan? Is it just is what it is type of thing?
Dan, yeah, for me, and Dan's gotten away from this, is kind of the overweight, middle-aged, hey, Dan. Now, Danny, I like better. It's just what I grew up with, maybe. And Daniel I use from time to time, but only in the official business purposes. So
I see. That's fair enough. Now, you might be familiar with Elizabeth Young Thomas. She was married last year, and she recently had a child. So she went from EY from SoFi to Elizabeth Young Thomas, now a mother. But you know what? Despite the fact that she's on maternity leave, and good for her, she should be, we still have Mario with probably maybe some assistance from Elizabeth, I'm not sure, sending us stuff. So let's look at this first slide, because this is sort of interesting. And this speaks to some of the things you were talking about earlier. Regardless of all this news and noise with tariffs, things had been slowing down. And this speaks to it right here, Danny, in terms of manufacturing and in terms of services. There was an inertia that was happening before all this noise started happening that's probably just being accelerated by said noise.
Well, that's my point. The Fed was probably on track to cut because of everything that was going on until the tariffs ruined Powell's soft landing. So we were already seeing that. We saw it from the airlines in January. We saw it from the airlines in February. We see it from, American Airlines today, looking back and on the guidance going forward. So this was already happening. And I think when you look at the goods number, which I think was strong, in March, people thought people were just stocking up ahead of
go forward
what might happen, right, for the tariffs. So listen, that's a pretty good, you could probably overlay that with the stock market at various parts of the on the way here on the charts, and those would probably match up. But it's not a secret that this has been going on for a while. And so I think I've talked about before, kind of the cuts in the government, like those jobs. It takes a long time to filter through what that's really going to mean. Are these people going to get rehired? What's going to happen? What's in the private sector, on the contractor side? People shutting down warehouses. I've talked also about, imagine being a private company, we're a public company, a private company that gets legitimate contracts from the government that also imports parts or does something for them. So it's a double whammy. You're shutting down your factories because you're not going to be able to even get the goods in to manufacture them. Do the uncertainty around. So it's just the uncertainty, guy, and people getting ahead of that. And so maybe part of it was getting ahead of the tariffs, but there was no doubt we were starting to slow down on the margin. So
I think the second bullet point is worth mentioning. Based on the partial data that's been released this month, so 60% of the regional Fed data, 3 out of 5, I can do that math. Listen to this. The April composites are tracking toward their lowest levels aside from 08, 09 and the COVID recession. I mean, that's significant. I mean, but again, you can listen to us talk all you want. This is not us making up data. These are actual data points that I think, again, goes back to your earlier point, is what is the right multiple in this environment. Now, if you think magically everything's going to start to turn up, then okay, I just don't think that's the case. So let's go to this next one, because this speaks to S&P 500.
Guy, can I make one other comment on that?
Danny, this is your rodeo, baby.
I just want to be
Yes.
clear. So what got us out of COVID was services sector, right?
Yep.
I mean, the spending, concerts, airlines, whatever it might be. You're not going to have that this time kind of coming out. So people want to believe, oh, I've seen this movie before. The supply chain issues. Well, we had people were bottled up for a year and a half. And so I think we need to understand that the economy is 75% plus services. And so when we were talking about tariffs and all that stuff, yes, it's an important part of the economy, but it's been the service-driven, consumer-led economy. And that, to me, is showing up also in other data. But I just wanted to add that to that when people try to compare certain time periods.
I think it's important. And if you think about what, there was that fire hose that came out in terms of liquidity at that time as well, that sort of basically it was a hyper stimulus that came into the market that, by the way, I was aware of, but I didn't realize the full ramifications of what it mean for the market. I just don't think that there's that bazooka this time. We'll see. This one, though, is interesting, and this speaks to what's happening in the environment. And I'll read it, but folks can look at it because it's a hard chart to sort of figure out what's going on. But basically what Elizabeth and Mario are saying is this is a textbook example of what happens when there's a growth scare. You go basically from cyclical, out of cyclical, into defensive stocks. And what really resonates with me here is, for so long, Danny, and I know it probably made you crazy, but you had to listen to people saying how historically cyclical sectors, for example, banks, but more importantly, semiconductors, they were no longer, something changed, right? There was some sort of sea change. But what we've learned is it's never different. And, they are as cyclical as anything else. And you're seeing right before your eyes the rotation out of the highly cyclical names into defensive, which typically happens during a growth scare. So speak to that.
Well, you just said what's happening. My favorite character on the show, What's Happening, was Rerun. And it's just rerunning. How what it's supposed to, you like that guy? I'm on today with you. We got this thing going on here.
I love Rerun.
By the way, the healthiest thing that you can see is a sector rotation and money stays in the S&P, right? That's the best thing that you can see. But again, fund managers have to underweight and overweight various sectors. That's what they do. And they pick their favorite names, the active managers within those sectors. And that's how the game is played. And the majority of money is managed that way. And the majority of portfolio managers, not hedge fund, not absolute return people, get paid on that. So what you'll do is, this is why I mentioned before, by quality. This is a stock picker's market. This is when you need to do your work. So, Guy, within all of those charts and within all the things would be certain names that are going to outperform. Take advantage of passive outflows by managing active money. That's what I have to say about that.
Whoa. That should be like a bumper sticker. I like that. By the way, that's a theme that we've talked about as well. When passive becomes active, it's never active on the way up. It's active on the way down. But that speaks to, just so you don't think we're all doom and gloom all the time, this next slide speaks to why, as scary as things can be, if you stay fully invested, regardless of the noise around, this is going back 100 years, basically, since 1927. And you can see it. If you just stay the course and tune out dipshits like me and say, you know what, I don't care what's going on, you're going to get a 6% annualized growth rate, which, you know what, not too shabby. If for some reason you miss the 10 best days, that drops down to 4.9%. Best 20 days, you can do the math. You miss the best 50 days. The point is of this slide is completely getting out of the market, at least for the last century or so, is typically not the way you want to be, because it's very difficult to time these things. We try to give you levels where things make sense and trading around things. And we're obviously speaking to more people that are trying to be tactical. But if you're just at home, just with your 401k, just plowing money in, this suggests that's the right thing to do, regardless of all the things you hear from me.
So the PTSD in the market, over the last 18 years is real. I mean, the great financial crisis, people shouldn't have been caught off guard, but I think the extent of it and the unknown leverage will hurt people. COVID, right? When that happened, right? You couldn't have seen that coming. How are you going to react to it? So it's easy to show a chart like this and say that. But to your point, like I said before, you can't chase the up days in the market, and you do not want to sell on the big down days in the market, is really what I would take from that. But behavioral finance is behavioral finance. And so it's easy to say this. I said to someone the other day, who said, "Oh, I'm going to buy the S&P when it gets to 4,800." I'm like, "No, you're not. No, you're not.
Because
when it gets there, you're going to be like, whoa, no one's going to." So again, to your point, stay disciplined. And again, over a long period of time. But let's keep in mind, the amount of retail investors that are out there now and have access to the markets is very different. So these charts look great, but you're going to have to deal with a lot more emotion, I think, than we ever have. And I think understanding market structure, right, and understanding the companies you own is key to what you're really bringing up here. And the truth, Guy, if you own quality and even throw in dividend-paying companies that have good balance sheets, you will be fine. But I do think you need to segregate certain ETFs or industries and look at it that way versus the overall market, in my opinion. So
you've talked about, this is a question from Gary Webb, who is also here every day. You've been pretty vocal in terms of the business model of a firm, and you've said 100 different times, like, you got to be tactical here. They're going to be rallies that are coming out of nowhere. I mean, this was a stock, by the way, in February that was, I think, traded up to $82, only then to subsequently be cut in half by earlier this month. I mean, that's pretty significant move. With all that said, Gary's asking about what your conviction, if any, is in terms of a firm. Like, understanding that, the business model, I would agree, is a little bit fugazi.
Yeah, listen, I think right here, the stock's probably in no man's land. Obviously, got way ahead of itself. Again, these are, for the most part, wholesale funded businesses that are dependent upon capital markets and private equity firms to do risk-sharing arrangements, to buy the loans, the buy now, pay later loans that they're creating to get off their balance sheet. You've seen a couple times. You could literally track that with credit spreads. As credit spreads widen, a firm stock goes down. And so Upstart's the other one, UPST, a little bit different animals. But keep in mind, these companies, both of them, the loans that they're producing, they're going to sell the best ones, keep the worst ones, so to speak, and mark their books accordingly on what the sale price was. I've seen this movie before. And so Upstart, I think, is much more of a financial type company than a firm is, but they're both dependent on gain on sale and on getting their loans off the balance sheet. And if credit starts to turn at all on consumer credit, they're both exposed. So I'm probably neutral more on a firm. I'm probably still more negative on Upstart at these levels. But I think Gary's question was put spreads and things like that when high vol stocks are probably the best way to express it rather than buying outright if you want to be bearish on it.
We've known each other quite some time. I consider you a dear friend. Hopefully you feel the same way. And I'm not trying to put words in your mouth.
Love you, Guy.
But I remember in 2022, 2023, you talking about a company that everybody had heard of, but people were not necessarily looking at. And that, of course, would be Walmart. That comes out WMT. And that, Danny Moses, would be our chart of the day. And look what Amanda did here. I mean, this is just tremendous. Every day, higher share prices. I mean, that is just so good. And this is all relative to the S&P 500. So, look, I remember last quarter, Danny, Dan and I said into the quarter in February that the stock had run up to about 104 or so. We still liked what was going on, but we said it's going to be very hard for them, in my opinion, at the time, to sort of say things and to print a number that would continue that course, that lower left, upper right, because on a valuation basis, it had gotten itself pretty expensive. The stock did sell off. Now, if I'm being honest, I did not think it was going to get down to, I think we traded down to almost like $80 or so. I think at that low on April 8th, maybe a little bit more, a little bit less, but you get my point. So I didn't think that was going to happen. But very quietly, Walmart's getting back on the horse here. And, you talked about stock pickers market. Well, you picked this one a while ago. Do you stay with it? Because I will continue to say, I mean, this is Walmart's world.
Right. So it's a consumer staple. So it gets the benefit of the sector rotation that we talked about. They have been growing their e-commerce business, obviously nowhere near Amazon, but it's becoming an important part of their business. So that has taken a little bit of business risk off the table of just being a pure in-store retailer. We know during inflation, people come and buy food there. That's not going to change. People are going to look through a bad quarter or two if it's a result of tariffs. Walmart has the pricing power to force their suppliers to take price so that Walmart gets a benefit to a degree. So the margin hit is less to Walmart. Walmart will pass on some of it to the consumer, obviously, and it's a safe place to be with a great balance sheet and a profile where they're buying back stock and paying out cash dividends. And so it's a valuation call you're making, and people are going to be willing to pay a premium for certainty, and they're a behemoth. And so there has been secular changes within their business over the last few years that I think that's a reason for the multiple expansion to a degree. It is expensive, but I don't believe valuation itself is ever a reason to sell or short a stock. But you're right. At some point, 45 times earnings, you got to ask yourself, okay. So I guess the flip side of that would be, Guy, if we were really to go into recession, the stock's very expensive because I don't care how good you are and how defensive you are in nature, but it's a safe place to hide. And people will take 10 to 15% downside to be in a Walmart versus something else. That's how
I agree with that. From Eddie, thoughts on shipping effects from China taking 30 to 50 days to hit inventories. That's 2 to 3 weeks away for consumers still. So look, I will tell you flat out, Eddie, I'm not an economist and I'm not a logistics expert, but I think to Danny's earlier point in the show, I mean, there was definitely a huge pull forward going on in terms of people trying to get ahead of this, which is going to completely skew these numbers. And the problem, of course, is the president can he can completely change his mind at any given moment and say, you know what, as he said the other day, I'm actually going to be nice with China. It's not going to be as draconian. I'm sort of paraphrasing. And this all becomes just a moot exercise. So I don't know how to answer this. And I think part of the reason why there's such lack of clarity is around this, which leads us to what, if you look at the next thing, what American Airlines just said. They're basically suspending guidance. Why? Because of what they deem to be a murky economic outlook. And that's a lot of companies. By the way, I think it was Delta, Danny, a week and a half or so ago, that gave two ranges of guidance. They basically said under this environment, under current environment, we see, I think, $11.5 to $13.5 for the full year, which you could drive a truck through. But they said under potential recession, they ratcheted it down to $7 to $9, which I don't think that's particularly helpful. We actually got a question yesterday or over the last couple of days. Do you think more and more companies are going to start to give two sets of guidance? And the short answer is I don't think so. But what I do think is going to happen is exactly this. I think companies are going to start to say, you know what, the lack of clarity is going to prohibit us from giving future guidance. Thoughts on that, real quick?
Yeah, let me address the container and then an American. So the part about we dealt with supply chain issues in COVID. You imagine what the prices of the shipping is going to be when tariffs kind of go back to normal and people are waiting to come in. People are thinking about that. I don't think people are factoring that in, that if you have built up inventory, not only is it going to take a long time to get here, the prices on those containers is going to be very high. Since the tragic fires in California, American Airlines has had issues, right? That's one of their big hubs. It's been out there. They had commented already earlier in the year, I think they started to see an economic slowdown, business travel slowing down, part of it related to DOGE cuts, because obviously there's a lot of government workers that fly around. They were kind of the first to talk about it. So that was an issue in January for American Airlines, updated again, I think in February, now March, and now they pulled their guidance. I think it's a combination now of everything, and they're in the middle of it. But it is that airlines are, to your point, semiconductors and airlines are kind of the first to see it. Traditional semiconductors, kind of the first to see it. And it's definitely painting a picture. And I guess at some point, these airline stocks could be really interesting. And you and I have talked about airlines in the past. I've never seen them as long-term investment vehicles. I see them as trading vehicles.
I agree.
And we bail them out on the way down. Government puts money into them on the way up. They gouge the consumer and come back with their hat in their hand again. So not a big fan in general of how they go. And then the whole issue with the fear of flying to a degree with the FAA cutbacks and so forth, and the tragic crashes that we've seen, not necessarily as a result of those, just tragic accidents, has been an issue. So airlines are a little bit different animal, but certainly telling a story.
Okay, why are my hands up? Anybody want to know why my hands are up? Because I'm showing people I'm not using my Google machine. You just said fear of flying. I believe that was a book written in the 1970s by Erica Jong, Jong, if I'm not mistaken. And that's Molly Jong Fast's mother. I mean,
is that really
the shit that I
didn't know that. That's
well,
amazing.
there you go. All See what you learn on this. I mean, Amanda is dying right now. But I'm going to give you a little bit of what Danny just said in terms of trading vehicles. We're looking at, you just saw American Airlines. Pull up a Southwest Airlines chart. Go back about 5 years. By the way, that comes out LUV for those playing our home game. You will see that.
I love what you did there
last night. See what I did there?
Yeah, I love what you did there.
Yeah. Well,
okay.
We are just traded down to levels we last saw in 2023. Now, this stock has been awful. But, you might have a bit of a tradable bottom here in love for those inclined. Now, I see what you see. I see crossing overs and moving averages. But, if this stock doesn't break down over the next couple of days and sort of holds that level, this could be a really interesting long side play. Maybe we'll look at options next week. Speaking of which, CC has given us 6% implied move in Google. So Google reports after the close. Let's throw up that chart. I don't know what to make of Google here. Everybody loves it on valuation, but man, oh man, this stock has been awful since January, basically.
Antitrust issues on top of everything else, but I'm a buyer on any dip. Great balance sheet. It's not overly expensive. It's in the high teens multiple on PE. They have the ability to pull back CapEx in certain areas if they see things slowing down, which I believe goes straight to the bottom line. Gemini, I think, is actually making inroads to a degree, and I'm not claiming to be a tech person, but again, this is a consumer staple to a degree, right? This is one of the tech names that is going to be very, very defensive in nature. So if something happens tonight and it has a bad quarter, they miss and guide down, I'm not saying that's going to happen. That's one you want to buy, guy. So I think you can feel safe owning Google here.
I don't know if Amanda, Jacob, Timmy, Hot Bill, CC, anybody, Dan's on a plane, I think. But if they could pull up, Timmy came up with the book, and if we can sort of throw this in just to show people that I actually am paying attention. And the recall I have is just unbelievable, if I may use that. And if Amanda doesn't want to put it up, that's fine. Because in the meantime, I have somebody asking the following question. What is today, April 24th? What happens on the first Saturday in May every year for the last, I think, 180 something years?
Run for the roses. So I will. So the On the Tape podcast, you remember a couple of weeks ago, I had a Masters preview with Ned Michaels. Came out of it okay because Rory bailed me out. I will have the Kentucky Derby preview, and Bob Baffert, who has 2 horses with our group, Starlight Racing, will be coming on like he came on for us 4 years ago. So the On the Tape podcast with Danny Moses. So check it out on Wednesday morning of that week. So that's next, what is that? That's next week. That'll be April, 29th, something in that range where I'll be talking to him. April 30th, it will be coming out. So
I mean, it's coming up.
And that's going to be, and regardless of Bob will have, but he has 2 horses in it with us. And I think Rodriguez.
Let me be a viewer here and ask you a question, because I'm always puzzled by this. Sometimes when one trainer has multiple horses, sometimes they go in as an entry. In other words, you bet one, you get both. Other times, can you explain that to the novice player here?
That's normally like a 1 and a 1A post, but let's keep in mind, the reason the Derby is so interesting is there's only one race a year that's run with 20 horses in it, and that's the Kentucky Derby. So that's not really that strategy there where you can do that. I'm sure online now on online gambling, you'll be able to kind of pair those up, but that's really, you don't really see that in the Derby as much. You'll have bets like, will a Baffert horse win? Will a D. Wayne Lucas horse win? But it should be a lot of fun. So
I'm looking forward to it. The fastest, most exciting 2 minutes in sports, as they say.
Rodriguez. I'm telling you right now, Rodriguez. That's
the horse.
Yes. So.
I mean, is this a chalk play, or are you getting?
No,
paid?
it'll be 8 to 1, 9 to 1.
8 to 1, 9 to 1.
Yes. So we'll see.
Wow, you're giving that out now.
Yep.
I'm watching the odds drop right before my eyes as our viewership goes. I've enjoyed this. See how fast that time goes by like this.
Amazing.
It's amazing, right?
Yep. Great to be with you, guy.
I am talking in a few minutes with Mike Cow. You know Mike Cow, Danny Moses.
I do.
You
Brilliant.
and I have spoken. Brilliant.
Yeah.
That will drop tomorrow. Danny Moses's On the Tape podcast drops left and right. Your conversations have been great. The feedback you're getting and we're getting is tremendous. People are saying, Danny, like a thoroughbred, he's like now a mature 3-year-old. You found your stride, I mean,
there you go.
That's beautiful.
I appreciate that. I did have Professor Plum 99, Michael Green on. Episode came out yesterday. Brilliant guy. Very thoughtful.
Did he kill somebody in the library?
That's why his Clue thing, I don't know we didn't really get into how he came up with that name. But anyway,
by the way,
get out of here, guy.
Clue, one of the shittiest movies I've ever seen.
Ever.
And one of the most ponderous board games. Now, my son Timmy is listening to this because he's forced to. But our daughter, for some reason, is just mesmerized by this game. Like, she wants to play Clue all the time. And it's just a dopey game because basically you roll the dice, you cheat, you put yourself in a room, you guess, you're wrong. You roll the dice again, you cheat, you find yourself in the billiard room. The whole thing is dumb.
Guy, maybe you should take the whole Adami family, They have those places they reenact. You enter, you have to figure it out. You go into simulated.
Those what do they call those? Yeah, no, Timmy and I did that.
They have these things.
I did that with Timmy, my son Guy, and I forget who else was with us, and we got out in like record time, like 16 minutes.
Nice job. All right. Yeah.
They gave us like a escape room. Jacob just all right.
Get us out of here, guy.
Tired.
Let's escape out of here.
Listen, the great Danny Moses, ladies and gentlemen. Round of applause. Thank you I love you. Thank everybody for joining us. As I said, tomorrow, Mike Cow. So be around for that, and we'll talk to you later, folks.